This is how I learn market structure as a beginner from scratch. So in this video, I'm going to show you how I learn market structure from scratch as a beginner. This knowledge helped me to understand the market structure and it also gave me positive results. So stick with me up to the end of the video as I'm going to show you how to do the same. So without wasting much of the time, let's dive into the market structure. One of the most important skills that you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You are going to trade all the market the same way. You need to study how the market moves and how traders behave in the market. The market structure is the study of the market behavior. And if you can master this skill, when you open your charts, you'll be able to answer these important questions. What are crowds doing? Who is in control of the market, buyers or sellers? What is the right time to place, enter or exit the market? And when are you going to stay away from the market? Through your price action analysis, you experience three types of markets: trending markets, range markets, and choppy markets. In this chapter, you will learn how to identify every market and how to trade it. So we start with trending markets. So trending markets are simply characterized by a repeating pattern or higher highs and higher lows in an uptrend market and lower highs and lower lows in a downtrend market. So this is an example of an uptrend market which have a series of higher highs, higher lows, higher highs, higher lows. So as you can see in the example, the market is making series of higher highs and higher lows, which indicates that the market is uptrending. You don't need indicators to decide if it is bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trending. So uptrends in a market. So these are the uptrends in a market. These are the uptrends. You go on a 4-hour time frame if you want to look for uptrends. So this is higher low, this is higher high, higher low, higher high, higher low, higher high, and this is where you are going to find your setups. This is another example of a downtrend market, which is making series of lower lows and lower highs reversed from this point, and then it start to make some lower highs like this, lower highs like this, lower highs like this, lower highs like this, and then lower low. This is a lower low, lower low, and then another lower low is right here. So these are higher highs and lower lows. How to find them on a chart? The example shows us a bearish market. As you can see, there are series of lower highs and lower lows, which indicate an obvious downtrend. Trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it is doing series of higher highs and higher lows, it is simply an uptrend market. Conversely, if it is making series of lower highs and lower lows, it is obviously a downtrend. According to the statistics, trends are estimated to occur 30% of the time. So while they are in motion, you have got to know how to take advantage of them. To determine whether a market is trending or not, you have to use bigger time frames such as the 4-hour, the day, or the weekly time frame. never try to use smaller time frames or determine the market structure, because smaller time frames they produce something called fake outs. So how to trade trending markets? If you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you look for buying opportunities because you have to trade with the trend. And if the market is bearish, you have to look for a selling opportunity. But the question is, what is the right time to enter a trend market? Trending markets are characterized by two important moves. The first move is called the impulsive move, and the second move is called the retracement move. See the example. So in this example, there is an impulsive move which is buying, and retracement move which is selling. So impulsive move means buying, retracement means selling. As you can see, the market is making higher highs and higher lows, which indicates a bullish market. If you see this market, you think of buying, but as you can see, the market is making two different moves. The first move is an impulsive move, and the second is a pullback of or a retracement move. It is also called a corrective move. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profit at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. If you can be aware of how trending markets move, you know that the best place to buy is at the beginning of an impulsive move. Traders who buy an uptrend at the beginning of a retracement move, they got caught by professional traders and they don't understand why market hit their stop loss because moving in the predicted direction. So this is another example of a bearish retracement and impulsive. So the example above shows a downtrend market. As you can see, the best trading session is to sell the market at the beginning of an impulsive move. If you try to sell in the retracement move, you be trapped by professional traders and you lose your trade. Now we know how to identify downtrend and uptrends and how to differentiate between an impulsive move and a retracement move. This is very important for you as a price action trader to know. But the most important question is how to identify the beginning of the impulsive move to enter the market in the right time with professional traders and avoid being trapped by the retracement move. To predict the beginning of the impulsive move in a trending market, you have to master drawing support and resistance level. So, what are support and resistance level and how to draw them on our charts? This is what we will see in the next chapter. So, the areas you must trade. If you want to trade, you need to start trading from this area to this area. If it is a downtrend, from this area to this one, from this area to this area. You can even see that the down movement is very longer than the retracement. See this one, and I need you to see another one. This one is again very long. So for you to be profitable, you need to use these retracement moves on a downtrend. For an uptrend, you use these ones. the impulsive, because the market is going up. You trade with the trend. You don't oppose the trend. So if the market is starting here and this is the highest point, you need to trend. You need to trade this area. If the market is starting from this area and then it ends at this area, you need to trade this area. So if this video was useful on your trading journey, you can consider subscribe, as we are going to dive deeper in trading concept for beginners.